Hey, I'm Ben from Modern Graham, and today we are going to do a stock analysis of a well-known company, Intel Corp. INTC is the ticker. The current price is 25.12, and the technology sector and semiconductors industry. So be sure to stick around and hear what I have to say about that. So we've got the balance sheet. These are what I view as the most important figures on the balance sheet, and they will all come into play later on in the valuation. We have current assets, current liabilities, total long-term debt, total assets, intangible assets, total liabilities, and outstanding shares. Those are all things to consider. Earnings for this company, we have this column here is the diluted earnings per share. That's the one you are familiar with from balance or from income statements. And this one is the earnings per share MG, the weighted average of the last 5 years. So what I do is, like I said, it's a weighted average taking 5 years, putting the most weight on the most recent and the least weight on the oldest. So we can look at the earnings, looking at the chart here, earnings per share, we saw a rise during the tech boom and then the tech crash. And then it crashed, of course. And then after that, it came back up, but then kind of dwindled a little bit before hitting a new norm after the financial crisis. And then now it's hit another new norm. Is it like this one? It goes up and then it just... I don't know how to describe it, but now it's come back down is the expectation. Earnings per share Modern Graham have kind of been on a growth trend here. And now it seems like it might be coming back down. The last time it came back down, so earnings per share were rising, or the weighted average were rising until 2015. And then it started to go back down. It went down to its trough in 2017, but it didn't really drop very far. And that's the whole point of this weighted average, is to smooth out a lot of those ups and downs. And this figure, coincidentally, went back to here. And so then it started to look at more of these figures here. So it's just something to keep in mind. Dividends. We have seen the dividends rise pretty well. You can see that on the chart here. Even when the earnings have gone down, the dividends have gone up. And that is exactly what we like to see in a company, is that dividend growth. The only year it did not grow is in 2014, where it stayed at 90 cents per share. We can look to see what was happening with earnings. Interestingly, their earnings did go up that year. So I'm not sure why the dividends didn't rise, but that is the only year since the tech crash, pretty much since that the dividend has not gone up. Dividend yield is about 2 or 3% most years, and dividend payout ratio is relatively low right now. So that's a good sign. They've had really high earnings, and you would expect that maybe the earnings would come back down, and that's what the market is certainly expecting, or analysts are expecting. This is the estimate for the next fiscal year. And with a low dividend payout ratio, when they've historically paid out between 40 and 50%, that means that they should be able to sustain this dividend rate. So that is good. Stage 1 of the analysis, let's go up to the top, is the company suitable for the defensive or enterprising investor? The defensive investor is defined as somebody who is wanting to have individual stocks in their portfolio, but may not be able to do extensive research into individual companies. So they have pretty stringent requirements for what they will even consider to invest in. First of all, we have an adequate size. It has to be greater than 2 billion. It passes that. It has to have a current ratio greater than 2. It fails in that regard. The current ratio of Intel is only 1.86, so we failed that test. Earnings stability. It has to have earnings positive for over 10 years. That it passes. Dividend payments for 10 years. It passes that. Increase in earnings per share of at least a third in the past 10 years using 3-year averages at the beginning and end. We actually have seen 129% growth in Intel's earnings over that time. So that is definitely a pass. PEMG, that is the price to earnings ratio using the earnings per share modern gram weighted average. And that you take the price 2512 divided by the earnings of 412, and you get PEMG of 6.09. That is lower than the defensive investor's requirement of 20, so it passes that test. Moderate price to assets, we have the price to book ratio is only 1.02, so we pass in that regard, and the backup test of price to book times PEMG, we pass that too. So we get 6 points. That makes it suitable for the defensive investor. The enterprising investor is somebody who is willing to do more research, so their requirements are not quite as stringent. In this situation, it is suitable for the defensive investor, so by default, it would be suitable for the enterprising investor. But let's go through the tests anyway. Current ratio is 1.86. That's greater than the enterprising investor's requirement of 1.5, so we pass there. Debt to net current assets is 1.39. That is higher than the requirement of below 1.1, so we fail that test. Positive earnings per share for at least 5 years, we pass that. Currently pays a dividend, we pass that. And earnings per share are greater than they were 5 years ago. In fact, they're more than double. So we pass that. It has a score of 4 points for the enterprising investor. So even if it wasn't suitable for the defensive investor, it would be suitable for the enterprising investor. Stage 2 is the determination of intrinsic value, and we look at the modern Graham value formula taken from Benjamin Graham's The Intelligent Investor. That is value equals earnings per share times 8.5 plus 2 times the growth rate. Earnings per share, I take the weighted average. As you've probably noticed, I do in a lot of parts of this. And to calculate that, again, we look at the 5 years, and we put the most weight to the most recent, and we get 4.12. Growth, we look at the earnings per share today and the earnings per share 5 years ago. We get a total growth of 41.59%. Divided by 5, we get to 8.32%. Then we knock that down even more because growth has the potential of swinging this value way around. So you want to be extra careful when you are picking your growth rate. So we are estimating 6.24% growth in this case. And when we plug those figures in, we get a value of 86.51 per share. As you can see in the chart, that is much higher than the current price. So over here, the modern Graham opinion is that it is undervalued. Looking at other things, the net current asset value is negative, so that doesn't play into this. We have it here, in case you're wondering. I have it in this box because if the modern Graham value were to come out to be lower than the net current asset value, this is like the floor. No company should be trading below the net current asset value. That should be the absolute floor. Even if the value based on the earnings is less, this is a liquidation value. And so it definitely should be the floor. Anyway, the modern Graham value based on 3% growth. So if you only assume 3% growth by this company, you'd get a growth rate of 59.80. Or a value of 59.80. If you assume a 0% growth, you get 35.05. So it's trading below that. So if you expect the company to grow at all in the long term, then it might be undervalued. The market right now is implying a negative growth rate of negative 1.2%. So that is taken by calculated by putting the price in for value and then solving for growth, and you get negative 1.2%. Modern Graham grade, looking at a few different factors that we have here. Investor suitability, it is suitable for the defensive investor, so we get 2 points there. It is undervalued, so we get 1 point. Trading below the Graham number, we'll talk about that in a moment. It's 1 point there. It does not have long-term dividend growth because of that 1 year that it did not grow the dividend. 0 points there. Dividend yield is above 2%, so half a point. PEMG is below its industry average, so another half point there. and it's not trading below the NCAV. So we've got another one. We've had several that have lately that have a score of 5. That gives it an A grade. Stage 3, further research. So at this point, if you've decided that it's suitable for your investor type and we've determined that it's undervalued, now is the time that you need to do further research to determine if you think this might be an okay fit for your individual portfolio. And to do that, we look at the net current asset value formula. Again, this one is negative, so it doesn't apply too much here, but it's good to know that that is actually not that low. Graham number formula, this is calculated by looking at a few of the defensive investor requirements and turning them into a formula. Somebody else did this long ago, and a lot of people like to use this when they're looking at things. Earnings per share, the current figure is $2.74. Book value per share is $24.65, and when you run that formula, the Graham number is $38.98. So that's one thing to keep in mind. Price to earnings, we have the price of $25.12. Earnings per share, modern Graham, the weighted average is 4.12. And the PEMG is only 6.09. That is a pretty good figure, I think. But you'd need to compare that to other figures. And when you're looking at different companies, current ratio is 1.86. Price to book is only 1.02. That's a really good price to book. Dividend yield is 5.71% based on the current dividend, and we've had 8 years of dividend growth. So those are key figures to look at. Let's move on. Okay, so stage 4 is to look at the chart. If you've gotten this far and you've determined that it might be a good fit for your portfolio, the next thing is to look at timing and trying to time the purchase to fit with a good time to buy. And this one is very, very intriguing. And I'll show you why. Let's zoom out a tiny bit. Going back to April, it's been on a downward trend, like pretty much all of the market. In fact, this trend really goes back even further. It's been coming down since, let's see, that is April of 21 there. It's been on its way down. That was where it pretty much hit its high, which matched January of 20, like just about. And then it has been coming down since then. But what's interesting now is it's one, near the bottom of the downward side of this trend. So you might expect it to bounce back up off of that. And two, this red support level here goes way back. If we go way back here, it was hit in August of 15, and the company bounced off of that. It had come back down and then bounced off of that. But going even further back from there, the company has hit that several times as a support or resistance level. And so 25, about 20, yeah, we're $25.38, $25, somewhere right in this range is a key point. And it is either going to fall through and continue on this trend, and then that is going to become a resistance level, or it is going to bounce up, and we're going to see it probably bounce around here, maybe come up and try to see if it can get above that trend line. So Intel is at a very intriguing spot, and it'll be interesting to see what happens. But yeah, click on the video on the screen now. That'll be the list of all 10 companies that have high yields for the defensive investor, of which Intel was one. Be sure to click to see the rest. Thanks for watching, and I'll catch you next time. Take care.